Welcome back to the channel. In part 1 of our deep dive into the psychology of money by Morgan Housel, we explored why your behavior, not intelligence, determines your financial success. Today, in part 2, we're diving into more mind-opening lessons, including how ego, past experiences, and our flawed perception of history shape the way we invest and build wealth. Let's continue our journey. Chapter 8. Man in the Car Paradox. Morgan introduces this concept by describing something we've all seen: a luxury car driving by, catching everyone's attention. But here's the twist. When you see someone in a Ferrari or a Lamborghini, your admiration isn't really for the driver. It's for the car. We imagine ourselves in it. We don't necessarily think the driver is successful. We project our desires onto the object. This is what Housel calls the man in the car paradox. Key lesson: buying expensive things to impress others often backfires. People admire the object, not the owner. Real respect comes not from what you show, but from what you quietly build. So before you spend money to signal success, ask yourself who you're really trying to impress. Chapter 9. Wealth is what you don't see. This chapter hits hard. We often confuse spending with wealth. Wealth isn't the cars, clothes, or vacations you post on Instagram. It's the money you don't spend, the investments that grow quietly, the savings that compound. As Housel puts it, spending money to show people how much money you have is the fastest way to have less money. Wealth is invisible. It's security, independence, and freedom, not just visible luxuries. This mindset shift is crucial. The next time you feel envy or pressure to spend, remember, real wealth is what stays in the account, not what's flaunted. Chapter 10. Save money. You'd think this chapter would be obvious, but Housel gives saving a surprisingly deep perspective. He says, building wealth has little to do with your income or investment returns, and lots to do with your savings rate. Even if you earn a lot, if you spend everything, you're not building wealth. Meanwhile, someone earning modestly but saving aggressively can become a millionaire over time. And here's the kicker. You don't need a reason to save. Save because the future is unpredictable. Save for flexibility, peace of mind, and unexpected opportunities. Saving gives you options, and options are priceless. Chapter 11. Reasonable greater than rational. Most financial advice tells us to be rational, but we're human, and humans are emotional. Housel argues that being reasonable is more sustainable than being purely rational. For example, paying off a mortgage early might not be the mathematically best choice if your interest rate is low. But if it gives you peace of mind and better sleep, it could be the right move. The goal isn't to beat spreadsheets. It's to build a strategy that you can stick with for decades. So don't chase the perfect financial formula. Chase the plan you can live with. Chapter 12. Surprise. In this chapter, Morgan reminds us that the most important financial events are always surprises. Think about September 11th, the 2008 financial crisis, or the COVID-19 pandemic. Almost no one predicted them, yet they reshaped the entire global economy. The lesson? History teaches us what's possible, not what's certain. Don't try to predict the next big shock. Instead, build a plan that's resilient. Prepare for the unexpected. Expect that the future will surprise you. That's the real power of smart financial thinking. Chapter 13. Room for error. This idea builds on the last one. Always leave room for error. When you're investing or planning financially, assume your assumptions will be wrong at some point. Because they will be. Housel compares this to wearing a seatbelt. You hope you'll never need it, but you wear it anyway. Margin of safety is key. Whether it's extra savings, insurance, or conservative projections, give yourself breathing room. Success isn't about being perfect. It's about being prepared. Chapter 14. You'll change. Here's a personal favorite. You are not your past self, and you won't be your future self either. The goals you have today may not be the ones you value tomorrow. Morgan warns against making 30-year financial decisions based on who you are at 25. Because your priorities will change. Your family will change. Your view of risk and wealth will change. Build flexibility into your plan. Leave space to pivot. This chapter encourages us to let go of rigid plans and embrace adaptability as part of financial wisdom. Chapter 15. Nothing's free. Every financial decision has a price, and often it's not money. The price of investing in the stock market? Volatility and uncertainty. The price of financial independence? Discipline and delayed gratification. But most people want the reward without the price. Morgan's advice is powerful. Stop looking for the free lunch. Instead, learn to identify and accept the cost, and pay it willingly. If you want the long-term gain, be ready for the short-term pain. That concludes Part 2 of our deep dive into the psychology of money by Morgan Housel. So far, we've learned that wealth isn't about status, ego, or luck. It's about quiet discipline, invisible savings, and the ability to adapt over time. If you enjoyed this video, be sure to subscribe and hit the notification bell so you don't miss Part 3, where we'll cover how greed, social comparison, and long-term patience define the financial greats.